This is the Silicon Valley real estate market update for the week ending April 25th. These are the key chapters that are in the YouTube description below, so you can jump to the chapter you find the most interesting. Let's get into the first slide. This is simply looking at the number of offers accepted in the past week, trying to look at what's going on in the marketplace. And it's going to be a little complicated because we have Easter. Easter moves basically from March 22nd all the way through April 25th. In the past 10 years, which is what my gray median line is based on, there was 1 week in the earliest time frame, 3 weeks in this second time frame, 2 weeks in the third time frame, 3 weeks in the fourth time frame, and 2 weeks in the fifth time frame. And that's shown by these vertical lines here. So the reason the blue line came down, the least number of offers you'd expect, is because that's the week of Easter for that particular year. And when you're looking at 10 percentile, you only look at the last one. So now that we finally have Easter behind us, we're all on equal footing. However, I think we need one more week because buyers work up until the holiday. Sellers take the week off before the holiday. So the sellers flooded us on the marketplace, and we'll be seeing that in a little bit with the huge increase in inventory. And buyers haven't had the opportunity to buy those listings yet. So it's going to be next week when both are back in balance that we'll finally be able to see whether the purple line is above or below the blue line. So are we selling within the normal bounds? Or are we now accepting fewer offers than we would anticipate doing even in a slow marketplace? And only time will tell. This is Silicon Valley, so all three counties. Real quickly, here's Santa Clara County right up touching the blue line. Here's San Mateo County, which had been holding strong until 2 weeks ago, dropping down and crossing over, now actually significantly below their blue line. And here's Alameda County, essentially just slightly below their blue line. All three have come down. All three are close or below the blue line. And again, next week is when we're back in balance. Here's the first typical summary slide. Inventory, you can see the inventory has gone up. We're pulling away from the blue line, so we're having more inventory now than you would expect. 13 weeks ago, we only had 1,300 listings, 1,360 listings. We now have just over 3,000 listings. So you've more than doubled your inventory in the last 13 weeks. 13 weeks ago, we were at 98% of the inventory you'd expect, and now you're at 136%. So you've picked up 38%, almost 40% of your inventory on top of the normal growth. In terms of raw counts, typical is 2,200. The most you'd expect is 2,800. Here you can see you're above the surplus, above more than you'd expect. So clearly, buyers now have choices. What does that mean? Well, it means that buyers have choices. Then you move on to looking at sellers, the offers accepted. How many buyers are out there? The inventory is the number of sellers, offers are the number of buyers. Here you started off at 13 weeks ago with 811 at 77%. You're now almost triple the number of offers. So offers have gone way up, but the percentage of normal is basically unchanged. I mean, you can't get closer than that, 76.7 from 76.6. The percentage of normal is absolutely there. It doesn't look like that, but it's a percentage of the gray line. It's the volume of buyers has not changed at all over the past 13 weeks. Number of transactions, that's actually successful closed transactions, which is slightly different. It accounts for transactions that fail and things of that nature. There you've gone from just over 1,000 to over 2,000. So you've doubled your number of transactions. You've gone from 73% of the typical level of transactions to 82. So you've actually closed more transactions in the past 5 weeks than you from 13 weeks ago. But again, you're at 2,000, and that's between typical and the fewest number of offers. It's about halfway in between. So you're clearly not having a robust year by any stretch of the imagination, but you're not having a terrible year as far as volume of transactions. But closed transactions are also what happened 5 weeks ago. And then I'm also going back another 5 weeks to get stable data. So we're looking up to 10, 11 weeks in the rearview mirror on the number of transactions that have actually closed. Moving on to days unsold inventory, this is the seller-buyer balance. You went from 120%, which is 20% slower marketplace than you would expect 13 weeks ago, at almost 60 days to 50 days. So you've actually had an improvement of the marketplace. But compared to the normal cycle, you've gone from 20% slower to now 62% slower than you typically are. What does that mean in terms? Well, you're at 50 days. The slowest you'd expect is only 43. So we're taking a whole week longer to sell out our existing inventory than you'd expect in the slowest marketplace for Silicon Valley. Remember, Silicon Valley is a fast-moving marketplace. So you go in anywhere else in the country and saying you're selling out your entire inventory in 50 days, they'll go, wow, that's a very fast-paced marketplace. That's true for the bulk of the country. It's not true for Silicon Valley. Typical is 30 days. So typically we're selling everything out in, a month, and now we're taking almost 2/3 longer than that, which is where the 61% comes from. Marketing time to sell. This is looking at the 75th percentile. There's a problem looking at the average. The average gets influenced by the seller that takes 2 years to sell and then finally sells. And the median is very stable index. So that's why I've chosen the 75th percentile. And if I was starting from scratch back in 1997 with all my insight that I have now, I probably would have used something like the 80 or 85th percentile instead of the 75th percentile. But quadrants are pretty typical in statistics, which is why I picked it initially. But anyway, you went from 27 days 13 weeks ago to 20 days. So that sounds like an improvement, except 13 weeks ago, the 27 days was only 63%. So you were selling it 37% faster, a third faster than you would expect to sell for that time of the year. Now you're actually taking that same third, but on the longer side. So you went from a third faster than typical to now a third slower than typical. So that's actually a pretty significant change. The range you'd expect is from 15 to 19 days. Now, someone might say there doesn't seem like much change between 20 and 19 days, but because of the fairly stable nature of this index, plus the fact that it takes time to accumulate times on the marketplace. So right after the first of the year, everybody comes flooding on the market. They all have 0 days on marketplace. It takes time, and it's more than a day to gain a day because a lot of the stuff is selling, but you can't gain more than a day at a time. So it takes time for that 20 days to increase higher than that. And I think that's the direction it's going to be going. Price reductions. This is where not only is it interesting to see what sellers are doing, but it's really a measure of sellers' expectations. When they list their property, they usually do their homework fairly accurately with the listing agent and price their property to come on the marketplace and sell. So when sellers are taking larger and more common price reductions, that means that their expectations cumulatively were higher than they should have been for the current market condition. That usually indicates that the market's been slowing when people weren't expecting it to slow. So 13 weeks ago, you were taking 0.6% price reduction, which may not sound like a lot, but that's because the vast majority of the sellers do no price adjustments whatsoever, and that was 98% of normal. So the 0.6% was pretty much typical. Now you're only taking 0.9%, so still less than 1%, but that's almost 3 times the magnitude of price reductions that you'd expect for this time of the year. In terms of raw numbers, you'd expect a third, 0.31%. You're at 90, so there's your 3 times the red hot marketplace where sellers' expectations were in line with the marketplace, or maybe the sellers were less optimistic than the market was. You only see 0.06% price reduction. That's essentially zero. And in a soft marketplace, you see 0.7%, so not even 2/3 of 1%. And now you're at 90% of 1%. So you're clearly taking more price reductions than typical. And this is the magnitude of those price reductions. Overbidding. This is really a lagging indicator, but real quick, you'd expect to be 2.8% overbid. You actually had 3.9. So 13 weeks ago, you had 1.1% more overbidding. So almost a third more overbidding than you'd expect. Right now, we're almost in alignment. So even though you've almost doubled the amount of overbidding to 7.7%, you'd expect it to be at 7.4%. So we're basically right at the typical range. But again, you can see you were between the gray line and the red line, the hot marketplace. And now you're basically right at the gray marketplace. And it's not the overbidding is really going down at all. It's the typical what you'd expect has been coming up. So the market's catching up to where the market's been. I also suspect in a couple more weeks, we will start seeing the purple line is actually going down. Here's looking long-term on the 3 key indicators. You start off with inventory, and you can see that inventory jumped up quite a bit compared to normal. but we're basically back up. So this is the Easter impact here, this 10%, or not quite 10%, something like about a 7 percentage point swing. And it's because sellers didn't list going into Easter. Now that we're past Easter, the sellers that were going to listed this week instead, and you bounce back up. Then you look at the number of offers accepted. Number of offers has gone down. It's been going down for not quite a quarter, but since before April 1st. April 1st is the vertical line on your quarter break, and that's probably about 3 weeks before. So somewhere around March 15th was in the most offers accepted, and then we've been coming down. And this is a percentage of normal, not just the magnitude, but a percentage of normal. And you can look back, I drew in the horizontal lines. There have been times like in 2023 where you had a lower percentage, but at the same time, the key indicator, days of unsold inventory, the turnover rate is right now higher compared to where you'd expect it to be. It's that 61% higher than you'd expect than any time in the past 10 and a half years, except for during the peak of the shelter in place when we couldn't even show properties right here in early 2020. So that's very noteworthy, and it's starting to be up by quite a bit. You know, your previous high, other than COVID, was here at about 145%, and you're at 161, almost 162%. Here's the active inventory and raw accounts. You can see the huge increase that we've gone from. So you've gone here from just a little over 13 weeks ago. Well, it'd be about 17 weeks ago. We were under 1,000 listings, about 900 listings. We're now at 3,000 listings. And you can see the little respite break right here for Easter. That's the sellers that didn't come on last week, and now they came on, so you went up a little bit steeper. So I'd expect this line to continue. And really, typically what you do is you look at the trend for the gray line, and that's what you'd expect the purple line doing, barring some other information. So since you're not quite at the peak yet, I'd expect that to continue to go. And it isn't always true, and we'll see that in an example where there's a time shift, which was something I still don't understand. Here's your active compared to normal, so you can see the dip down for Easter and then the recovery, and you can see here again in early 2019, there was a higher percentage of active listings. Moving on to offers accepted, same concept here where you can see the downturn over here on the right-hand side. We peaked right at about the beginning of April. We were coming up, sort of following the normal trend. And then basically since April, this has been coming down gradually. And meanwhile, the blue line's coming up. So if the trend continues in a couple more weeks, the two will cross and will probably be below the blue line for less offers than you'd expect. Here's that same thing. And you can see right here it's showing actually a little bit before April 1st. We started a downturn compared to normal. We reached 90% of normal, and we're down now to about 76.5% of normal. We're still up of where we were in 2023, but we are lower than most of the past 10 years. Here's the days of unsold inventory. And again, an increasing days of unsold inventory is taking longer to turn over your marketplace, which is a slowing marketplace. You can see you're up here at 50 days. The highest number you'd expect is somewhere down here around 43 days, maybe. Typical, you'd expect to be 30. So we're a third longer than you'd expect it to be based on a typical marketplace. Here's the days of unsold inventory on a percentage basis. You can see that on a percentage basis, like I said, on the side back, is higher than any time other than COVID right here in early 2020. And right now, I think the number was 161.3 or 6 or something like that, but just over 160% of where you'd expect it to be. And again, a high number is low. You can see the dip going into Easter because buyers continue to buy and sellers don't list. And now the flood after Easter with the sellers coming on the marketplace. Here's your marketing time. You can see that started to increase since basically Valentine's Day. And this is the time shift that I mentioned briefly earlier. Normally, you'd expect the bottom of the marketplace to be halfway through this quarter. It was halfway through first quarter, and there's also a shift up here. The longest marketing times were right at New Year's, where typically you'd expect that to be about the middle of first quarter, right around Valentine's Day. Here's the same concept where I pulled out the typical line and compared to percentage of normal. You can see that you went from 30% of normal, so a very fast marketplace, essentially the fastest marketplace we really had, up to the slowest marketplace. And this is the slide that drew my attention. And I actually still think that that's pretty accurate. To me, it looks like the market's right where we were on Valentine's Day of 2022. And we've been going up just like we did in 2022. What happened after 2022? About May 1st of 2022, everything stopped and the market prices started to come down. There's not, it's not a prediction, but, that's where it looks like the fundamentals, as far as days on marketing time are concerned, looks like we are. There's a few other indicators that I'll try to point out that indicate to me the peak of the 2025 season was right around Valentine's Day of 2025. So we're already looking in the rearview mirror. Typically, it's between about April 15th and May 15th. Right in that time frame is typically the peak of the marketplace. I think it happened much earlier this year, and only time will tell. Here's the sellers taking the largest price reductions. Now, this slide, you pay a little attention. 100% is up here, so that means sellers are getting 100% of their asking price, or a 0% price reduction, 2% price reduction, all the way down here to 20%. So here again, a downward graph is increasing price reductions, which is a negative number. So look at the trend, and this is another trend that changed right around Valentine's Day, where the amount of seller price decreases has increased, and it was on a gradual slope up until basically very close to the end of first quarter. And sometime right around the quarter change, it went down and it fell down fairly significantly, and it appears to be continuing to go down. So sellers are taking larger price reductions. This is the 90th percentile. So it's the seller that's taking the 10th most highest price reduction, if that makes any sense. Here's on a percentage basis. So you can see that we were higher in 2023. This was almost like your Easter blip in 2022. This is your Easter blip in 2025. And it's going to be interesting to see if we turn around and come back up like we did in 2022. Here's the average seller's price reduction. So this is in here, not that I'm a big fan of it, but it's just to show that I've used the 10 percentile because I think it's a better indicator, but the average sort of shows the same thing. Right around the Valentine's Day, you went into a gradual increase in decreasing prices, so more price reductions. And then right around the quarter change, you went in this fairly steep decline of price reductions. This is compared to normal. You can see the Easter correction, and now we're back down. It's going to be, and the reason you have a holiday impact here is if a seller's going to do a price reduction, they're not going to want to do it on Easter week. So that's why there was fewer price reductions, and I'd expect next week we'll see this number come back down again. Again, there's no way to know, but that's what I would expect. This is the frequency of the seller's ask price reductions. So here, the more frequent the price reductions are, the slower the marketplace is, which is why the blue line is on top. You can see, again, it bottomed out right around the middle of February, and it's been climbing ever since. And we're rapidly approaching the blue line at a time when all three lines are going to go up. So the frequency of seller price reductions is most likely going to continue going into the future. Here's compared to typical. Now here, there's still some room. We have time back here in 2018 and 19 when you had a higher number. And obviously at the latter part of 2022 and early 2023, where the frequency of seller price reductions were higher. But when you start looking at 10 years, you can start seeing that we're sort of much higher than you'd expect. You'd expect to be down here somewhere in this white area. And meanwhile, you're up here solidly in the blue, which is a cool marketplace, of course. There's the magnitude of overbidding, a lagging indicator, but you can see that peaked just right after the first of the quarter and it's come down. And you're basically right now slightly below normal. And this is looking at the magnitude of overbidding. And this is the median overbid. And this is down at around 5%. The number that we saw earlier in the presentation that was 7%, that was the average overbidding. And that's why the numbers, they align, but they're not exactly the same. And they're not exactly the same percentage of normal. If I remember correctly, the average overbidding was slightly higher than average, where this is dead on average, at least optically looking at it. And here you can see it's slightly above, but very close to average. Average would be on the zero line. Same concept where I take the gray circular line and compare to normal. So here you're basically having overbidding, but look at the reduction. You've gone from basically, what would that be? The second week in March or something like that to current, you've come down quite a bit. And this is raw percentage. So 0 is where you're matching the typical overbid. This would be 2% overbidding. This would be almost 3.5% overbidding over what you'd expect it to be based on the typical at that time of the year. Here's the frequency of overbidding. You can see it rolled over, and it rolled over again earlier. So again, we're having this time shift where the maximum overbidding typically happens later in the year. It happened right around the quarter change, right around April 1st. And we're now on a downward trend. And because of the downward trend in the typical going forward, I'd expect the frequency of overbidding to decrease going forward from this time. And again, the frequency of overbidding, because I need the sold price, is looking in the rearview mirror by the duration of the escrow, which is about 5-6 weeks, plus the duration of my gathering data. And I use a 5-week sampling for stability purposes. Here's comparing to the typical line. So you can see you were more frequent overbidding all of last year, basically all of 2024 until the end of first quarter. And now you're coming down, and now you're a little bit below the typical overbidding, but you're still within that normal realm of what you'd expect it to be. Here's my pricing long-term on log paper. The 10.9% is if you draw a straight line through, and then if you break it into 2 segments, we had a segment of 12.5 and then a segment of about 3.3, which is probably more accurate. I believe that this price is noticing it's starting to roll over. And if you look back in time, normally it's midway through second quarter. I suspect we're about ready to roll over and see those sale prices starting to come down for the balance of the year. Again, there's no way to know, but that's the expectation. I'm doing something slightly different here partway through, and hopefully it works. I didn't have time to try it out. But the purple line is the current line, and this days on market distribution is the current line. We're starting off a year ago on the dotted line, and you can see the dotted line is a hotter marketplace. So a year ago, April 26, 2024, was a hotter marketplace than the purple line, the current line, in April 26 of 2025. And this was also the hottest for 2024. So from here, it cools off. So there you can see it's cooling off. And then you're just cooling off for the balance of the year. So the fact that you'll see in a little bit, hopefully, that we've already started cooling off is significant. And it's not that we're started now, but we started off several weeks ago. There's the coolest marketplace. Now you're rapidly improving. That's the hottest marketplace, and I froze it. So our hottest marketplace last year was April 26th, and I think it was actually April 19th, and I don't plot it because I jumped 2 weeks at a time. But this April 26th was our hottest week showing on this graph. This year, it was April 21st. So we already peaked out, because look, as we continue, you're already cooling. So that shows the time shift. Doing the same thing on the largest price reductions. Look at the gap between this year and last year. Last year at this time, only 7% of the sellers were doing a price reduction. This year, it's 12.5% of the sellers, almost double the number of sellers who are doing a price reduction this year than last year. Let's step through and look at it. You can see that you're cooling from last year. So again, this week a year ago was the hottest of the week being shown. And you're just basically bouncing around this, what I call the summer doldrums. And then after the Halloween, you start increasing. Now you're heating up. And right there, this is the hottest marketplace for this year. So again, there's a huge difference. And again, this is February 21st. And last year, it was April 26th. So a time shift quite a bit. But from this point forward, we're going to see that we're cooling off consistently. And now we're going to see a big jump, another big jump, and then the current week. And now we're looking at buyer overbidding and going through and doing the same thing. You're basically at the peak of the market for a couple more weeks, still there. Now you're cooling off. And this is later in the year because of the length of closing. So instead of Halloween, it's November, Thanksgiving, before it starts really cooling off. Right there. There's the coolest marketplace for the year, which is why I froze it. So the coolest was January 24th of this year. And then you started heating up. And now you've already hit the doldrums, and now it's actually cooling off, and that's definitely a cooling off. So the overbidding is already starting to cool off. And if again you can compare it to last year, which is up here, you're taking significantly less overbidding in 2025 than we did in 2024. Here now is looking at comparing the three counties. We have San Mateo County in the orange, which is the least amount of inventory, but it's approaching its record high level of inventory for any time in the past 10 years. Probably the high point is right here in 2018. Santa Clara County isn't at its peak by any stretch of the imagination, but it's quite a bit higher than it's been for the last several years. Since you have to go back to 2019, it looks like, in order to have more inventory. And the same of Alameda County. You got to basically come back here to pre-pandemic to have this level of inventory. Here's offers accepted. Santa Clara County coming down, but having the most offers. We're down to 900 offers, down from about 975. Alameda County has been sort of floating around this 800 number for about 4 weeks now. And San Mateo County has rolled over, it looks like, and gone down. Now, going down this last week again could easily be impacted by Easter. Here's your days on unsold inventory. So this is the balance, and an increasing days on unsold inventory is a slowing of the marketplace. Santa Clara County has slowed significantly. We've gone from basically 32 days right at the quarter change to 44 days. That's a pretty significant change, and it's probably the county that's done the biggest percent change. San Mateo County has also gone from 38 to about 44, almost the same level now as Santa Clara County. You'd have to get into the decimal point to look at the difference. And Alameda County started slowing earlier because that's clearly slowing before the end of first quarter, and it's now approaching 60 days of unsold inventory. Here's marketing time, sort of the same order. Alameda County has the longest marketing time at 24 days, then Santa Clara County at 18, and San Mateo County is the fastest at 16. This is the time for the 3 out of 4 sellers to sell their properties. Here's price reductions. Alameda County in the gray has done a fairly significant increase, but all 3 of these now are right at basically the same level here. And again, it may not sound like a lot, but you're taking about 0.9%. Santa Clara County was 0.9. I can't read what the other 3 are because unfortunately Excel were overwrites. Here's looking at the frequency of those price reductions. Alameda County has the most frequent price reductions at almost 15% of the sellers doing price reductions. San Mateo County has the least at 10%, and Santa Clara County is in the middle at 12% of the sellers are doing price reductions. So for Santa Clara County, that's basically 1 in 8 sellers does a price reduction before their offer comes in. Here's the magnitude of overbidding. San Mateo County has the least overbidding, but Santa Clara County is basically at the same level. I call them both about 107. Well, San Mateo County is probably about 107.25, and Santa Clara is probably about 107.5. Alameda County, even though it's the slowest marketing time, the longest days on unsold inventory, it's got the most overbidding. So when buyers are coming there, they feel competitive and are overbidding more than Santa Clara or Santa Clara, which is just something that's been going on for a while now, but it's almost hard to explain based on the other metrics. Here's the frequency of overbidding. They're all 3 are very close together, between 72 and 74%. I mean, you can't get closer than that, and you can sort of see them here, all 3 of them. Here's your long-term appreciation. Santa Clara County has had the highest appreciation. And since you're using a fixed number being the last 9 months of 2015, this is the same thing that prices are doing. So prices have rolled over. They peaked right here at the end of first quarter, beginning of second quarter, and they've rolled over in Santa Clara. They rolled over in Alameda County, and they bounced in San Mateo County. Here's median sold price for all 3 counties on log paper. You can see that Santa Clara County has the highest price at just under 2.1 million. San Mateo County is close, approaching 2.1 million. And then down here, Alameda County is the most affordable at about 13.5. Same information on regular paper. And I'll explain the price fluctuation here that I saw. Last week, I made a comment of the huge price reduction San Mateo County had, and now San Mateo County had a huge price increase. When you see something like that based on 5-week data, you absolutely assume your data is wrong. And I did that this morning, and I took the time and I went back and I actually gathered the data for this data point and the data for that data point, and it is accurate. It's just a fluke where the prices are changing that dramatically in San Mateo County when you're using 80% of the same data. And the reason I say I'm using 80% of the same data is the data points here are from 6 weeks ago to 1 week ago. The data points from here are from 5 weeks ago to present day. So the only data that's changing is you're dropping off 6 weeks ago and adding in the present week. And you just don't expect those kinds of price changes. But it's just a market mix of what happened to sell during those two time frames. I've confirmed this data and I'm very confident. I lined up a property address to property address. I was shocked when I saw it worked out that way because I was expecting to find a data error, and it is actual in the data. That's what you call statistical flukes. That's how you can make statistics say anything you want. You can now come and paint a huge picture on how San Mateo County has had this huge price increase, and it would be accurate, but it would also be misleading based on more information. Here's my micro-market data maps. This is showing active inventory. For the first 3 slides for Alameda County, it's one color for the whole county because I don't have the micro-market data. But you can see right off the bat, you have more inventory than you typically do, except for in Saratoga, Los Gatos. It's the one bright spot where there's only 80% of the inventory. You can start off here and see Silicon Valley's got a third more inventory than expect. Then each county, all 3 counties are here. And then the micro-market areas within the county, except for the first 3 slides, Alameda County is one number. Here's the same concept with offers. And again, offers are only at 77% of what you'd expect countywide, and this is very close. But San Mateo County is doing better at 90%, but it's a small county, so it doesn't bring up the overall number for the other 2 counties. Here's looking at the days unsold inventory compared to the 10-year median. You can see Saratoga, Los Gatos is the one right spot, and that's because they were more offers and less inventory than typical. So they're actually turning over in 70% of the time, so quicker turnover. You can see Silicon Valley is 62% longer than normal. And again, for the most part, very close together, 159% for Santa Clara, 150% for San Mateo County, and 102/3%, 167% for Alameda County. Here's the raw number, so not comparing to anything, just where are you fastest. So Campbell, Cupertino is fast. Los Altos, Palo Alto is fast. The fast colors are in red. The slow colors are in blue. The slowest is the Hayward area, where you're over 100 days. And again, you can see Silicon Valley as a whole is at 50 days. And then you can see each of the 3 counties. The only county that's at 50 days really is Alameda County, and it's at 60. Here's the time for 3/4 of sellers to sell. So keep in mind, even though I'm sort of maybe pessimistic in the data I'm presenting, we're still 3/4 of the sellers in Silicon Valley are selling their home in under 3 weeks. So it's a fast-paced marketplace. It's just not as fast as we normally are. We're normally on fire. We're normally probably doing it in about 10 days. Here's your seller price adjustment, only 0.9%. This is actually interesting, and we'll see it in the numbers maybe if we have time. All 3 of these look like the same data point. And so, again, I thought it was a data error, but we'll get to that story later. Here's the frequency of price adjustments, somewhere around 12.6%. So that's 1 in 8 sellers are doing a price adjustment before the offer comes in. Here is the buyer's overbid. So this is going to be the average overbid. So that's the higher number at 7%. The median was closer to, what was it, 4% or something like that. So your average overbid is right around 7%, and Alameda County is the high at 8%. Here's the frequency of overbidding. 3/4 of your sellers are still getting overbid. So you can't be too unhappy. 71, 72% of the sellers getting more than their ask price. Here's the long-term appreciation. The red is the higher appreciation, the more affordable areas. The blue is the least amount of appreciation, the more expensive areas. Here is my pricing, and instead of just following the median price, which is the middle number here, the 1.7 million for all of Silicon Valley, I put in the cheapest 10 percentile at 900,000 and the most expensive 90 percentile at 3.6 million. So you get a range. So every one of your micro market areas in each of the 3 counties, you can get a price sandwich And that's where the bulk of the properties are going to be in that range for single family homes. Here's a summary of all the information we just went over. So you can start off on the left-hand side and pick your micro market areas you're interested in seeing market conditions, or find your budget area over here based on loan qualifications and come across and see market conditions for that micro market area. Here's the number of sales. Want to point out that, look at this, you're at 2120 this year. Last year we were at 2195. So we're almost, 75 fewer offers than a week ago. Last week, we're within 2 of now changing positions from last year. And we're within 3 for 2 weeks ago. And these numbers here will most likely continue to drop as transactions fail, because an accepted offer, in my definition, is an offer that was accepted and successfully closes escrow. So if any time in 13 weeks after that offer was successfully accepted, if that escrow fails, it drops off as being counting from that point forward as an offer accepted. Here is the slide I was making reference to earlier. When I normally only look at this, the seller price reductions to 1 decimal point. So all 4 of these were 99.1. And I had to go out to 3 digits to start getting a separation. So you can see that they're very close together. So you can see that all 3 of these would round to 99.1, and they're very close even at this level. I mean, you're 4,000ths above 9.1, 1,000ths below, and 3,000ths below. Again, this is something, when I saw that, I assumed it was a decimal data error for some reason. I thought I was copying the same number 4 times. So I went back into my data that I keep. I expanded the decimal places, and once I got to 3 decimals, I could see that there was difference in the data. So again, I have a lot of confidence in the data I present. There's going to be errors in the data when I'm presenting this much data this quickly after acquiring it. I acquire it last night, starting at midnight, process it overnight, correct the errors that I find from 6 a.m. to 9 a.m. and go live with the data. There isn't time to catch all the errors based on the amount of information, but I look for the things that I think are most likely errors, and I'm not finding very many. So I have a high degree of confidence, not 100%, but a high degree. We've been talking about the Silicon Valley real estate marketplace here in Silicon Valley, 3 counties, Santa Clara County, San Mateo County, and Alameda County. We will be talking about the greater Bay Area, 13 counties and 5 regions. You type in the blue YouTube to get to the archives of my past presentations. I leave them online so you can go back and check. To join the presentation Saturday morning live, you type in the green root URL and add in the year, which is 2025 at 9 a.m. and you can join the presentation and ask questions, which I would appreciate. If you want the handout, you put in the green URL plus H for handout, the year, month, and date code. So today's would be 25/04/25. It will be up by about 6 o'clock tonight. If you want a specific episode and you know what episode you want, the green root URL, the year, month, date code, and it comes right up. I'm Richard Calhoun, real estate broker with Creekside Realty. My contact information is here. I represent buyers or sellers in single agency transactions. I'd really appreciate some likes and subscriptions if you're not already subscribed. And let's see if I have any questions. Let's move on and talk about the greater Bay Area, 13 counties, 5 regions. Here are the 5 regions listed. You have Silicon Valley being Santa Clara, San Mateo, and Alameda counties. City, San Francisco, and Merced. North Bay being Sonoma, Napa, Solano, and Contra Costa. Central Valley being San Joaquin and Sacramento. And Central Coast being Santa Cruz and Monterey. Here's active inventory. You can see inventory in all 5 regions is up significantly. Part of that is because Easter, there's a dip of new listings going into Easter weekend, and then after Easter weekend, there's a flood of new listings coming on the marketplace. Here's the number of offers. Offers are down in 3 out of the 5 regions, and that's not unheard of. And again, that's again Easter. Sellers didn't come on the market because of the holiday weekend, so there's less new inventory for buyers to pick from. So buyers, the active buyers that are going out every weekend, they don't see as much new inventory, so fewer of them write up offers. Biggest decrease I'm seeing is Silicon Valley, Central Coast, and then Central Valley. I would actually say the cities is flat, and North Bay actually saw an increase in a number of offers accepted. Days unsold inventory is a supply-demand balance. How quickly is the market turning over? and they're all very reasonable speeds. The slowest is the Central Coast, and it is typically the slowest. You can look back and see the ocean blue is sort of on the top all the time, and it's currently just shy of 82 days. So then you have days on sold inventory. It's up in it's up in all 5 regions. It's up probably the most in Silicon Valley. Silicon Valley is tied with the cities at about 50 days to sell your existing inventory, so a little bit over a month and a half. Then you have the Central Valley just shy of 70 days. And then you have the North Bay just over 70 days, just shy of 75 days actually. And the Central Coast just shy of 85 days, so approaching 3 months. But notice that the Central Coast, the blue, is typically at the very top of the line. And also notice that the bottom of the line is purple, which is Silicon Valley. So those two tend to be on each of the extremes. Here's the time that it takes 3 out of 4 sellers to go. Silicon Valley has gone up the most and is currently at 20 days, so just shy of 3 weeks for 3/4 of the sellers to sell. Cities is next at about 25 days. And then you have a 2-way tie at about 36 days with Central Coast and Central Valley. And the slowest area, the area where it's taking the longest for 3 out of 4 sellers to sell, is the North Bay at 44 days. Ask price reductions, this is the average, so it's a very small number. If the sellers were taking no price reductions, you'd be up here at 100%. You can see the San Francisco and the Silicon Valley are pretty close together, somewhere between 3/4 and 1% price reduction. Then you have Central Valley and the North Bay very close together at about 1.3% decrease, so 1.33%. And then the area doing the largest price reductions are the Central Coast at about 1.6% price reduction, so about 1 2/3. Frequency is how common, very common in very uncommon, not common in any of the areas. The area where it's most common is Central Valley, at just about 27% of the sellers, so a little over 1 in 4. Then you have North Bay and the Central Coast at just under 1 in 4 sellers taking price reductions. And then you come down to the cities and Silicon Valley at about 12%, which is about 1 in 8 sellers taking a price reduction. This is the magnitude of overbidding. And keep in mind, not only do you have to go back 5 years that I get the data, as I said earlier, which is going back to March 22nd, you go back an additional length of escrow, which is anywhere from 4 to 6 weeks, because you need the escrows to actually close in order to get the sale price to get the overbidding. But anyway, your overbidding is up here at about, and this is average overbidding, not median overbidding. And the highest is the cities at about 9% overbid. Silicon Valley is just shy of 8%. Then you drop down to the North Bay at about 1.5% overbidding. And then you have the Central Valley and the Central Coast, both at just under or just about 1/4% of a price reduction. So 1/4 of 1% in those two areas. So not only are they taking price reductions to attract the offer, they're taking another 1/4% on average when they actually negotiate the offer. Here's the frequency of overbidding. You can see that we vary from a slow of about 36% of sellers getting overbid, more than 1 in 3. Then you have the Central Coast. Then you have the Central Valley at 40%, North Bay at about 48%, cities at about 68%, and the highest is Silicon Valley at about 72. So in rough terms, anywhere from 1 in 3 to 1 in 7, anywhere from about 3.5 out of 10. That's pretty bad too. Anywhere from about 1 in 3 sellers to 3 out of 4 sellers getting more than their asking price. Here's the long-term appreciation since 2015. The last 9 months are my base. You can see Silicon Valley had the highest rate of appreciation, followed by the Central Valley, followed by the Central Coast. North Bay is still reasonable at 68% appreciation, and the area that's been doing the least well since the pandemic. Notice how the orange has been on the bottom pretty much ever since the pandemic, is the cities at 58% appreciation. So you've either got 50% return on your money or 100% return on your money, depending on which area you purchased in. Here's the sold price. You can see that the cities is close to its previous peak, but still below the peak in 2022. Silicon Valley is right at their previous peaks. Central Coast goes below their previous peaks. North Bay goes below their previous peaks. And the price sensitivity in the Central Valley is so tight, it's a lot smoother. But there are times, especially in 2022, when prices were higher in the Central Valley, but they're also right at their record high right now. Here's the tables. You can see right off the bat, you have 9% more active listings this week than you did last week. That's pretty significant. You can see 12% in the cities. That's huge. The other areas are closer to 5%. Then looking at offers, down 2% in Silicon Valley, up almost 2% in the city. So going in opposite direction, up 3% in the North Bay. So clearly not all areas move the same. And that's just the numbers to show you that there's numbers behind my presentation. And with that, we're back to the chart of the different chapters that you can link to, jump to using the links in the YouTube description below. I'm not seeing any unmuted mics. Thanks for joining. Take care and appreciate any likes and subscriptions. Bye for now.